Let's shift gears here for a second. We talked a little bit earlier about tax benefits to Avantis. And in my mind, that brings up exchange-traded funds, or commonly known as ETFs.
Yeah.
Give us your definition of an ETF and explain, if you would, why is it that ETFs are considered more tax efficient than an open-end mutual fund?
Yeah, that's a great question. If we look at cash flows in the market, the market is based on a lot of informed people and advisors that inform investors. And you see cash flows into mutual funds, money is flying out of mutual funds, so investors leaving mutual funds and moving to ETF. So if you just look into the market is telling us who is the winner and who is the losing. But let's explain why is that the case. So both the ETF and the mutual fund are what we call commingled vehicles. So many investors benefit from investing together in an ETF and also in a mutual fund. So it's not a vehicle, it's not an investment for just one person like a separate account will be. It's an investment for many people that get together at the same time.
Okay.
So if you have a mutual fund, someone goes and tries to purchase mutual fund shares. What that someone does is send cash to the mutual fund. And if I'm the portfolio manager of a mutual fund, I see that you are sending cash. I find cash in my custody account, and I have to use that cash to buy securities. Who pays for the cost of buying securities? Every investor. You give me the money, yes. Every investor pays investing your money. Yeah?
Yes.
If you take your money out, yeah, I have to send you cash. But in order to send you cash, I have to have cash sitting in my mutual fund, because it's not that I can sell securities and send you cash. If I sell securities, the securities, when you sell securities in the market, you don't get the cash immediately, you get it 2 days later. So if you are redeeming from the mutual fund, I have to have cash in the mutual fund to be able to wire you the money. And then I have to sell securities to replenish my cash, yeah? And if I don't have enough cash, I have to borrow money to send you the cash that you need. So who pays for selling the securities and the line of credit and all that? You don't pay because you are already out. All the other shareholders that stay there are paying for all that. And it's more. When I sold securities to send you the cash, I may be realizing capital gains. And who gets the capital gains realization? Not you, because you're out. All the other shareholders get the 1099 at the end of the year, saying you owe taxes because Wes took money out. So you are realizing capital gains, and everyone's paying but you. Well, we don't say Wes, but if they knew, they will blame you. So when you have an ETF, all that is gone. So ETF doesn't deal for cash. It's not that when you buy an ETF in the market, I, as a portfolio manager of the ETF, I get cash. I don't get cash. When you buy an ETF in the market, the broker, the market maker that sold you ETF, in order to get the ETF share, they have to give me securities. What securities? The securities that I happen to want to create a better portfolio. So I have a list of securities that I accept. It's called the creation basket. I have a set of securities that I accept to issue an ETF share that I will give to the market maker, and then the market maker will give it to you. So who pays for that transaction? The long-term shareholders don't pay, because I don't receive cash when I buy securities. I directly receive the securities. So the long-term shareholders are very well protected. You pay your way in, what is fair, and then the long-term shareholders don't have to pay for that cost. And in the way out is exactly the same. You sell an ETF share in the market, yeah? The market maker buys from you. Now the market maker wants their cash, yeah, because he's going to give you cash. In order to get the cash, they will call me and say, Eduardo, I want to get rid of these ETF shares. What do? We give them securities. What securities? The securities that we don't want in the ETF anymore. We give it to them. They sell them in the market and give you your cash. And that's an in-kind redemption process. You can notice that I didn't have to carry cash as in a mutual fund because I'm not wiring you cash. I didn't need to sell securities because I deliver securities in kind, so I didn't incur in cost of selling the securities, and even more. Since I didn't sell securities, I didn't realize capital gains. So the long-term shareholders in ETF at the end of the year, for that in-kind transaction process, will not get a 1099. So the structure is a more modern structure that really has a lot of advantages. That's why the market has decided to use them, that structure.
A couple of comments on that. One, in an ETF, if securities have dividends, those still get passed through to the investors.
Absolutely.
I want to make sure we don't leave the wrong impression with investors that does get passed through.
That works exactly the same as in a mutual fund and an ETF. In both, in a mutual fund and ETF, if a security, let's say Apple, pays a dividend, that dividend has to be distributed at the end of the year, or in a quarterly basis, whatever the frequency is, to the shareholder.
And then on the capital gain side, just to clarify, because this topic can get complicated to some folks, I own shares of the ETF, and liquidations out of the ETF happen, and you already explained that those securities get sent out. As a result of that, all that truly happens for me as the owner of the ETF is I have my original cost basis, and if the ETF has done its job over time, at the point that I decide to sell, I will incur a capital gain at that time based on my original cost basis, but I won't get any of the capital gains distributions from other, as you said, investors in the fund that might liquidate prior to my decision to get out. Is that accurate?
That's absolutely accurate. And look at this year. For example, this year, pitifully, we have this year is a down market. So we have seen, we don't know how it's going to end. Hopefully it's going to go up dramatically. We don't know. But we know that from the end of last year to now, market has been going down. And so what can happen? If a lot of people redeem money from a mutual fund, they can finish with a capital gains tax bill at the end of the year and negative performance. What is something that really people don't want? So the ETF provides a lot of protections. It's on expectations. You have a lot of protections that will minimize the tax bill, if not completely eliminate the 1099 with the capital gains line item. But that, not every ETF is done the same way, and so you have to be a little bit careful.
That was going to be my next question.
You have to be a little bit careful, and that's why I think that advisors provide a great service because, look, my mom is not going to analyze every ETF structure and say this is an ETF that will provide tax advantages and good benefits on expected returns and whatnot. Why? Because my mom has other business, not investment. No? She was a teacher. No? If I need to fix the roof of my house, if I try to do it, it's probably not going to work very well because my experience doing that is probably not the best.
But you're an engineer. You'll know how to do it, right?
Even if I'm an engineer, it's probably not going to be very well. You hire someone that has expertise. So I think when you are analyzing ETF or asset allocation on everything like that, that's where people like you guys come and say, look, we analyzed that, we did the due diligence, and these are the ones that can provide advantage to you, Mr. Investor.
So one part about your explanation, maybe you could give me a little more clarity. So you described in an open-end fund how the cash comes in, you have to go and buy the securities, and there's transaction costs involved with that. At some point in the ETF process, securities have to be purchased. Who bears the cost of those transactions?
That's a beautiful. So think about the ETF. Everyone bears the cost of the transaction. So you come in, everyone pays for your transaction. You go out, everyone pays. No, if you go out, you don't pay, everyone else pays because you're already out.
So you'd say ETF, you mean in the open-end mutual fund?
In the open mutual fund. In the open-end mutual fund, in just a mutual fund. Most of them are open-end investment companies, so the 40 Act applies to both. But in a mutual fund, when you buy, you become a shareholder of the mutual fund. You send cash. The cash has to be used to buy securities.
Right.
Who pays for the cost of buying all those securities? Everyone.
Correct. Yes.
When you redeem, you want your cash, you redeem, you're already out.
Right.
So I have to sell securities. Who pays for that? Everyone but you, because you're already out.
Yes.
And who gets a capital gains realization from selling those securities? Well, everyone but you, because you're already out. So at the end of the year, someone will get 1099s. In an ETF, when you come in, you go and buy an ETF share in the market. That ETF share in the market will have some spread between bid and ask. The cost of buying, the price for buying and the cost for selling, is not going to be the same. There will be a little bit gap that is called the spread.
Yes.
So in an ETF, the person coming in pays a little bit more than the person going out. And that spread is the cost of basically delivering the securities to the ETF or accepting the securities in the way out. So who pays? The person paying in general is the person coming in and out. What is really, really more fair? Now, something that is extremely interesting is that, every security in the market, you go to Apple, you go to Microsoft, you go to Berkshire Hathaway, all of them have this bid-ask spread. The price for buying is different from the price of selling, if you are going to buy or sell a security. So if you look at the average bid-ask spreads of the securities inside an ETF, that average bid-ask spread of the securities inside the ETF, in general, in the vast majority of cases, is much wider than the bid-ask spread of the ETF.
Okay.
And there is a lot of academic work about that, but it comes from the risk that market makers are facing, some of that, and why. Imagine you're a market maker, and I tell you, hey, Wes, I'm going to sell you 1 million shares of this security. One name, 1 million shares to you. Immediately you will say, I don't know if Eduardo has information that no one else has, and I have to protect myself. So when you are trading and making markets in one name, you have to price with wider spreads because you have the risk of having asymmetric information, someone that knows more than you, giving you something that then is going to do not as well and you lose money. When the market makers create markets on ETF, the baskets is not one name, it's hundreds of names. So if it's hundreds of names, that risk of someone knowing more than you is gone. It's completely minimized because if I have information, it's on one name, maybe two names. Having information across everything. So that cost is gone. So that's why they can price it more attractively.
So it sounds like what you just said, going back to Markowitz, is the correlation between risk and reward applies across many different fields or many different areas of investing. Because the market maker is, if he's going to take more risk, he or she is going to want more reward. So the spread widens.
To be fair, applies everywhere. Imagine that you are an insurance company and you're going to sell me car insurance and you're going to sell to someone that is way more cautious than me, car insurance. Or my son, when I have 3 sons, one is 20, one is 18, the other one 15. When they came to start driving, the cost of insurance to insure them was very different. The cost of insurance to insure someone that is my age. I don't think I have a driving ticket for more than 20 years. I don't remember one. And so that's the insurance company is pricing their risk relative to the benefits that they need to have as a company to survive and create value for the shareholders, employees, and whatnot. So yeah, this applies everywhere.
Okay, good.